just an analogy that I want to kind of throw in the mix, which I think is a thread that is really worth pulling on, is that, imagine that we're all property investors and we're all on a racetrack, right? And over the last few years, everyone's been careening down the straight, foot to the floor, going as fast as they can, riding high on the straight line of low interest rates and high liquidity with cash sloshing around in the economy, low unemployment and everything.
This sounds great.
Yeah, I know. It's awesome. And everyone's just been hooning. Everyone's been going as fast as they can. Now, when you're on the straights, realistically, whenever you're in a race like that, the only thing that's going to differentiate who goes faster on the straights is who's got a better vehicle. Now, in the context of that, in the vehicle of you, that would be who's got better access to capital, who's got more liquid cash reserves, who's got a bit larger borrowing capacity, all of that kind of stuff. That's the thing that will dictate how fast you go. If you've got not much money and not much borrowing capacity, then your car is going to go slower on the straight than someone who's got more cash and more borrowing capacity and more appetite for it, right? But barring that, everyone's been able to go as fast as possible careening down these straights. Now, what has happened is the racetrack has entered into another phase. We've gone from the straights and now we've entered into the chicanes, into the turns. But here's the thing: the winners of the races aren't decided on the straights. They're decided in the curve, in the bendy sections, because that's where skill and strategy matters more than the vehicle that you've got. That's where the game is won. And so what's happening with a lot of investors is they've jumped on, they've started the car, they've started driving on the straight. They're like, Yahoo, racing's easy. I'm just racing down a straight. It's all straight lines. You just point and shoot. You just put your foot to the pedal and hang on to the steering wheel and off we go. Now they've arrived at the corners, the winding section of the track, and they're going, I don't know what this is. I don't know how to behave in this environment. What does this mean? Should I turn hard? Should I turn slow? Should I accelerate? Should I brake? I don't know. And so there's a lot of confusion. Some people are trying to act as though they're still on the straight and they go off track. Some people are saying, I don't know what corners are, and they're just stopping. And both of those two things are going to mean that you lose the race. And the investors who are most able to manipulate their own thinking to strategically adapt to the environment and navigate those corners are the ones that are going to win. And the thing about racetracks is they usually come back around and you end up back on the straight. And so if you end up on the straight further ahead than everyone else, you're going to go faster and you're going to win the race. And this is kind of where we're at. And I just see this idea that it's kind of like we've approached some cataclysmic event. We haven't. Like interest rates are most likely the rate rises will slow down, if not stop, if not reverse this year. That is the most likely scenario that is going to happen. That is going to bring a return to consumer sentiment. We've still got record low unemployment. There's still a lot of stuff going for it, but everyone's kind of seeing this obstacle and getting in their own way. Now, that being said, and I promise I'll shut up and let you get a word in edgeways in a second. That being said, the environment is different, right? The environment is different to 12 months ago to 24 months ago. And what I mean by that specifically is your ability to derive cash flow from assets has fundamentally changed right now compared to a couple of years ago. So, you know what? I'm just going to keep going, and you guys can just interject if you want to get in somewhere.
And if you can just one thing I would love for you to bring into this, you've described like the analogy I like a lot here. I really do. That describes my feeling. I feel like I've been on the straight. I get the game. Now the corners have come up and the things that used to work don't work. Right? It's not the same at all. It's like I find myself in these uncharted territories. Not that I can't see this, but like I question, let's just go slow and wait for the next straight. Like, or do I learn, develop new skills or work out what these corners are? So I'd just love if you could describe what the corners are in this analogy or things and then go into this cash flow component because I think they're kind of tied.
Because my racehorse was like second half of last year, I was coming up to the corner and I just fucking stopped. And I'm like, hey, stop, horsey.
What do you mean 8% brakes? Brakes.
I'm like, do I want to turn the corner at all? Like, and I'm like, nah, maybe.
Yeah. So yes, the corners. Well, the corners are those constraints, right? The corners are those constraints. It's cash flow, capital, borrowing capacity. Like they're the things that people need to navigate in order to continue to wind their way around the track. Now, here is the fundamental difference in the current environment versus like the previous environment over the last couple of years is, as I mentioned, cash flow. Rates, right? And rates have been the greatest dictator of that capacity to derive cash flow from an asset. Now, rents are rising at record rates, and nothing is going to change that because there is no fundamental structural shift happening in the property landscape that is going to address the rental crisis. It's only getting worse. And what's funny about that is that renters believe that landlords are the root of all evil because they are the cause of the rental crisis, but it's actually the opposite. It's homeowners. It's the fact that more homeowners have bought properties in the last couple of years and there's less rental stock on the market, which is driving actually a greater rental crisis. That's actually the fundamental reason. But there's no more properties getting built. Like, that's an issue. But if I told you that you couldn't get cash flow anymore, what would you do? If your goal was like, I want to get cash flow from property, and I said, well, that's cool, you can't. Like, you just can't. What would you do? Would you just quit? Would you give up? Or would you try and take a different approach? Now, I'll expand on that a little bit because we, as an organization, we have long purported the value of getting high growth and high cash flow assets. And we've been able to do that systematically for a number of years. Now, right now, it kind of doesn't matter what your yield looks like. There's a very good chance that based on your loan structure, you're still going to not end up with net positive cash flow. Now, we actually took a list of the top, few hundred yielding suburbs in the country. We took the suburbs and we ranked them by highest yield to lowest yield. There's a few thousand in a list. And we went from the top down to see if we could find any higher yielding markets that would be good to invest in so that we could help our clients to get more cash flow. And you know what we found? We were already in the highest yielding suburbs that were actually investable because there were some higher yielding suburbs, but they were like middle of outback Northern Territory somewhere, which is not investable suburbs. So it's like, okay, well, if we're already in the highest yielding investable suburbs in the country and many of our clients are still not getting cash flow right now, then what does that tell you? Does that tell you that it might be a fool's errand to chase cash flow in the current environment? Does that tell you that you might need to change your approach or change your perspective on what a success metric looks like in your property portfolio? And what I find really interesting about this is I know that there are property professionals out there or property organizations out there who have long purported the benefits of negative cash flow, buying in blue chip areas with low yields. And because of the consumer sentiment backlash of people saying, oh, no, I'm scared now because interest rates are going up, they have now shifted their approach to talk about things like, let's go get cash flow, except they're going to Brisbane to get 4% yields and stuff and trying to purport that that is going to be cash flow positive. I can fundamentally tell you that there is no fact behind that. You can say that it's going to be cash flow positive if you don't factor in, loan costs and operating expenses, but there's not going to be any cash flow there. And so what's happening is more and more people, and we talk, and Grant, you touched on it earlier about like the masses and going against the masses, and we can kind of go into that because what's happening is people have gotten scared and they're going, oh, we need to go for cash flow, except they just might not be able to get it, which says to me that they're all chasing something that doesn't exist. They're chasing fool's gold. So what can the astute investor do? What can the intelligent investor do? The intelligent investor can say, well, what is my situation? How can I change my approach and my success metrics? Or specifically, how do I need to think about what types of assets might contribute best to my current portfolio? And to give some depth to that, what that could look like, right, is if you actually look at your situation, you might want cash flow. We all want cash flow, right? You might say, I want cash flow. But actually, if you can understand that the current environment is probably transient because the moment that you buy a property, you lock in the price, rents are going to continue to rise, interest rates are probably going to come down, the current moment will not last. And if you have a sufficient amount of income, cash flow, because cash flow is derived from both your portfolio and your income, right? It's your personal cash flow. So if you have enough cash flow in the ecosystem of you and enough capital that you could continue forward even without deriving cash flow from the asset, could you then change the perspective and say, well, would it be okay if I targeted lower yielding assets that might give me a better opportunity to get more capital growth because that's going to help me later on with the access to capital side of the equation because I'm going to build up a bigger capital base. Now, you might also say, well, I bought properties in a trust and I thought they were going to be cash flow positive and now they're cash flow negative and just Just for clarity, anytime you mention trust, you've got to say this is not financial advice, so go get advice. This is not legal anything.
Thanks,
Charlie's disclaimer at the start of the episode, right? But just for context,
if we mention trust, it means you should not trust us.
Yeah,
to be clear.
Yeah.
If we say trust, that's it's a reminder, don't trust us on trusts.
Exactly, right? But if you've got a trust and it's cash flow negative, then you're not able to offset the losses in your personal name, so you get no tax benefits on it. So your losses are siloed in the trust. That can be bad. Could you, and this is just a hypothetical, I'm not giving investment advice here, but I'm just posing a way to think differently in this context. Could you buy a property for the purposes of being an Airbnb property that could potentially have higher cash flow, which could offset the cash flow negativity in your trust, which would then give you advantageous aspects of your borrowing capabilities as well? And so you get to then think a little laterally. You get to think, okay, well, what could I do? Should I actually top grade my portfolio? Maybe I've got 3, 4, 5, 6, 7, 8, 9, 10 properties in my portfolio. Could I top grade them, work out the best 70% in my portfolio and drop the bottom 30% or 10% in your portfolio so that you can open up your borrowing capacity, increase your access to capital, free up some of that debt capability, all of that kind of stuff, and allow you to then make strategically different investments. And so it is this moment in time where the capability to think contrary to the general sentiment and general populace is the thing that is going to allow people to navigate those the bendy section of the track.
All right, fellow property investor, if you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.